affordable housing is a ton of work. All the stuff they say about affordable housing, in my opinion, is true. Like it's way more work. There's a ton of you got random maintenance stuff. You have people tearing up units. We have evictions every month. It's all those things. Mm-hmm. But also the cash flow is not touchable with the market rate deal. I mean, it's so much better from a return standpoint. So as long as you're willing to deal with those headaches, then I think affordable housing is great.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How we doing, bud?
We were good. We got a very comical email this morning. Not the one you were talking about, but I think you forwarded the one from Info about that mobile home park in Florida.
Uh-huh. So
he had an attached OM in the body of the email with a price of 5.7, but the title of the email said 6.6 or 6.3. So I emailed him and I said, how'd the price change? How'd it go up? $600,000. And he was like, oh, getting back to you on price. And it's another one of these guys that probably read some article and is doing something they're not supposed to do. But with deals at a premium, you give everything a little bit more of a chance now instead of just killing it instantaneously. But his reaction was priceless when I told him that, because he, that's just not paying attention. When you forward an OM and you just delete the names of the brokers, mm-hmm. You're going to figure it out. I think everyone thinks everyone's stupid, but that's how my morning started. So I have no complaint. And we lost power for a second, but other than that, we're good.
Interesting. Yeah. I've seen some people have only just started getting power back up on Long Island. Shockingly, we weren't hit at all. I mean, we were like, oh, that wasn't so bad of a storm. And then we turned on the news and started driving around. There's trees down. Crazy. Nobody has power. We were like, oh.
My parents, it's been a week today. They still don't have power. We have a generator. So I walked down this morning and the generator kicked in and I heard it on and I said, that's strange. But no, it was bad. I mean, my parents live 2.5 miles away from me, give or take. It took me 45 minutes to get to their house.
Oh, really?
Yeah, because there was just trees. Every street was closed with trees. It was, it was interesting.
Huh. No, that is interesting. And it's funny, too, going back to the deal, there's been one circling around right now in Bradenton that's listed with CBRE. I have the email in my inbox, and they keep sending all the info with a 3% markup fee. They did it with another CBRE deal in Jacksonville, too.
If anybody, when people listen to this, if you're listening, just strongly recommend it. I think all three of us here would tell you the same thing. Don't be a jerk off and just blast out broker deals. I mean, you're going to get caught. It's not worth it. Or you got to send them to it's two people. It's just not a good look. I mean, it's just not the way to get started. So yeah, that's my piece of advice before, we get this rolling.
Yeah, for sure. I think I've had people where I've told them hey, if you try to do a big property, $20 million plus, $10 million plus with a regional national brokerage, nobody's going to buy that from you. And I always get the response back, I've done it before, and I doubt somebody's done it before. It's probably just someone sold you on a mini course or told you how to do it. If you're thinking about going down that route, you want to do it for, a sub $3 million property with a small brokerage firm, a little bit different. But you want to start talking about your CBREs, your ARA Newmarks, your Cushman Wakefields. It's never going to happen. Anybody can sign up for those distribution lists. You're never going to get a 3%, 1% fee. It's just not going to happen. So spare yourself the time. Don't even go down that route. It doesn't happen. You're better off doing something else. So it's just funny for us. It's comical. But be that as it may, I do want to get into the episode because we've been going on long enough, and we've got an awesome guest in today. We met a few months back, did an Instagram live just around coronavirus, heard his story, thought he'd be a great guest, should have had him on sooner. So I'm very excited to have him on this morning. But with that being said, AJ, thanks for coming on, bud.
Hey, thanks for having me. I'm excited to do it.
Awesome. So you want to kick things off, just tell everybody a little bit about you, who you are,
sure.
Journey, what you do.
Yeah. Mm-hmm. So we're a small real estate company in Dallas, Texas, buy and hold rentals, any asset class really, but our focus has been on residential. We started in 2012, just myself and my wife. doing house hacking. We bought a fourplex that had a basement, converted the basement into a fifth unit, and lived in that unit for a while, from 2012 to maybe 2018. Or maybe 2018, 2017, somewhere in there. So we've just slowly, it was real slow start, and just buying properties when we save enough money, buy a deal, save up more money, buy another deal. And then, somewhere along the way that starts snowballing. So probably about 3 years ago, really started ramping up. We were buying a lot more properties every year, buying properties every month, So that at some point along the way, my wife went full time with it actually first as a property manager. She manages all of our property. And then later on, I went mostly full time. I still do a little consulting for actually a construction company in addition to the real estate investing. But anyway, that's been kind of our story. It's been awesome. We got extremely lucky. We obviously started in 2012, which was very lucky because the market was on fire. The prices were super depressed. And then also we bought in a neighborhood in Dallas called Oak Cliff, which went through a huge revitalization. So some of our properties have gone up 2 or 3x since we bought them. It's been totally crazy. So we utilize kind of the BRRRR strategy, though unofficially. We're not doing it real fast like a typical BRRRR will buy. It's not like it's as systematic as that. We buy it, we stabilize it. Whenever we need the money, we'll come back and do a refinance on it. Mm-hmm. But so that's kind of us in a nutshell. Gotcha. We currently have 195 units, a storage deal, and 2 office buildings. The units are split up. About 50 of them are like house duplex units, and then 145 of them are multifamilies.
Gotcha. Awesome. I'm curious, just really quick, 2012 seems like before a lot of people, before Bigger Pockets, before house hacking was this big thing that more people know about. How did you guys learn about it, and how'd you get into it? Yeah.
So I pretty much knew, at one point I wanted to be a realtor. I kind of was interested in real estate from a young age. Mm-hmm. Wasn't very academic, so I liked the idea of like working on houses and whatnot. But I went to college and majored in real estate and finance. Barely graduated, but I did graduate. And so I kind of knew what I wanted to do. I knew that I wanted to. That's why I bought that's why I did the house hack. No one was doing house hacks when we bought this fourplex into the house hack. In fact, I didn't even know how to do it well enough because Bigger Pockets wasn't really out there pushing that. So we still put 20% down. We didn't realize you could do, because we just called a couple mortgage brokers and they didn't know you could do the 3.5. They thought on a fourplex you couldn't do the 3.5% down thing. And I didn't do enough digging. So we still scraped together 20% down. We sold some stuff. We borrowed $15,000 from someone, and it was a $225,000 purchase. So we had to have roughly $45,000. I had my license, so we used my commission as part of it. It was we had to compile all these different little piles of money to get that one. And actually, I think the first episode of the Bigger Pockets podcast came out January 2012. So and that was when we bought that property, our first property. So I kind of grew. That was for the first year after buying that. I found somewhere along there, I found Bigger Pockets, and I started listening to that, and it really did. They don't get super deep, but when you're starting, those are like rules of thumbs. It helps, So listen to that, learned a lot through there. Probably learned as much there, frankly, as I did in getting my real estate and finance degree. So anyway, that was kind of how we got going in it. It took us from buying that first property to buying the next. We bought 2 duplexes after that, and it took us 2 years to save up the money. So from 2012, 2014, we just were stashing away money, basically.
Yeah, I hear you. What were you doing at the time?
I had a sales job for an environmental engineering company, and my wife was a teacher at the local school. So we had a reasonable income. I think our combined income was probably like $90,000 or something. Not a bunch, but we had zero housing expense, right? Because we were living in the basement. We actually were making money on that property and living there for free. So we had that, and so we were able to save. We saved her entire income for the entire time she was working. Actually, we never spent any of her money. Always went into a separate account, which we would save for buying real estate.
Awesome. I love that. Yeah, I think that's one of the biggest problems when, especially younger people, but anybody is looking to start, the dollars at the beginning are so low, and you ramp up, you get all excited, you save up, you buy your first one, and then it's like the money you get from it is nothing. Or the house, if it's a house hack, it makes you nothing, or you break even, but you're saving money. And it's like this big excitement up to it. And then it's almost, I can imagine where it's like there's just nothing really comes of it. Like nothing really changes. And it's such like a slow grind to get from like that first one to that second one. And then that third one comes a tiny bit quicker because probably your income's a little bit higher. You're making a little bit more money from deals, but it's still a long time. And it's not until you start getting, like you said, 6, 7, 8 years deep, and you can start maybe saving a little bit more, making a little more income. Your properties are making more. You probably have a refi or two in there that you really can start, compounding on top of that.
Yeah, the refinances is what really allowed us to like start leveling up. But all that being said, if you use the refinance strategy, the BRRRR strategy, whatever you want to call it, if you use that strategy, you got to own a ridiculous amount of houses to make a living off of. Because every time you do BRRRR or refinance the property, you're decreasing the cash flow. So you got to have a whole bunch. I'd reckon you got to have probably, in my market, you probably got to have 40 or 50 houses, even to do it, even as a single person, to go full time with it. You'd have to have a bunch of them because once you refinance, you cut that cash flow down to, $100 a house, $50 a house, whatever, Now, great, you get to go buy 2 more houses with the refinance money. So that's how it works. And it's good, and you're paying down debt, and it's appreciating. I think it's a good strategy, but you really gotta. People think they're gonna get a couple little properties and retire. That's not how it works, especially if you use that strategy.
No, I think the way that I've started thinking about it, that I think people get confused on, is when you do that BRRRR strategy and you refi, people are like, oh, it's great, I'm making infinite cash flow, or I'm making these super high cash flow returns. Yeah. But the reality of the situation is you wouldn't be able to pull all that money out if there wasn't some equity in the building. So you're still making a probably relatively average cash flow on that property. Right. You just now have equity in that building. So, if it's, if you're making $100 a month, so $1,200, if it was 10%, that's $12,000. If it was a little bit less, you're talking $15,000, $20,000. You have money tied up in that building, but people don't think about it that way. So it still takes capital or equity to be able to earn passive income. You just did it through sweat equity to earn that equity, have capital. So you've still got to build up capital and build up equity to get to a point where you can retire on that. And I think people don't think about it that way, at least as far as I've talked to people, where they just go, oh, I'll make infinite cash flow, or I'll make, an infinite return on my money. But it's just not possible. You're not going to get to, $1 million in passive income by doing a couple, small little things, even if it's infinite. It's not really infinite.
Yeah. And I think people make the huge mistake I see people make at the beginning is not underwriting the deals correctly, not accounting for expenses that are going to be there. So they think people get into it, like you said, they get excited, which is good, good to be excited, but they aren't honest with themselves about what it's going to cost to run the deal, specifically on these like single family duplexes. They run at a really high expense ratio. I mean, it's our average across our whole portfolio of residential is like 45% expense ratio. Mm-hmm. Well, that's a lot. That's before you even hit your mortgage. So you really need, one of the rules I use, it's not a bigger pockets rule, but one of the rules I use is I want my mortgage to be like 30 to 35% of the rental income. So it's a different way to look at it. But if you take your gross income, you say, okay, I want my mortgage to be like 35% of that. Yeah. If it's a big multifamily, you could probably push up like 40% of it. But,
yeah. I mean, ours are equally as low. Most of our properties are expenses without the mortgage. I've never reversed it this weird. We always do a break-even occupancy. So expenses and mortgage, where can it drop down to? And we always want to be in the 70s. And typically our normal expenses are 45 to 50%. So that would put...
That includes vacancy there, right? That 45 to 50? Are you carrying vacancy as an expense or no?
No, it's above the line. So it's 40. Okay. I forget if it's gross or if it's net rental income.
Yeah, but either way, it's gross.
Either way, it wouldn't move the needle a whole lot. It'd be, a couple percentage point difference. So, let's say you figure 50%, that would mean our mortgage is 20 to 25%.
Right.
of
Yeah.
our income. So it's not,
Right.
it's not very high. So it's an interesting, you've basically backed it out a different way, but the same thing. So I
Yeah.
think
I mean, and that's, yeah. I mean, I hear all the time newbies and they're like, I got this deal, the mortgage, and in their mind, the mortgage includes the taxes and insurance. So the mortgage is like $800 and the rent's $900. So it's going to be great. I'm going to make money. I'm like, you have no idea what's coming for you. I mean, you're going to get hosed on that deal. You're going to be bleeding every single month to keep that deal alive. And that's the thing that people got to, I wish that was pushed on more. Like the deal's got to be pretty freaking good. You know, it's not like you can't just go buy the house that happens to be next to you that's for sale and rent it out and make money. It's got to be a pretty smoking good deal to actually make money at the end of the day.
it's tough because I have, now that I've been doing real estate for 4 or 5 years, I will have conversations, people in family, friends, acquaintances will talk to me about it sometimes. And either it's a lot of my friends looking to get into it, or I have older family and acquaintances that have been doing it for a while. And it's always a very fine line I have to trot, because I have like, especially like relatives or family friends that have been doing it. They probably will do great because they bought the property years ago. And like you said, if you bought anything in the last 10 years, it's just gone up. And unless the world implodes, you'll do fine, probably. Yeah. But oftentimes they just talk about the mortgage. You know, I ask, I've asked before, like, you know, what's the cost of the property? And they just tell me what they bought it for. You know, it's like, they don't quite understand the full amount that goes into it, but that's also okay too. Like, not everything has to be, you know, if you're just buying 1 or 2 things to help you on the side and you just want extra money coming in and you say, you know, I'll float the expenses on the side, that's okay. And stuff in New York's a little bit different too, because it's more appreciation based than cash flow based. But you're 100% right. People just see the mortgage and then they try to get a certain amount of dollars over the mortgage. They don't think about what happens if you have to replace the roof in 2 years, or you know,
vacancy.
Vacancy. You have a burner that goes. So many things that can kill your cash flow, and it's just, those are just tougher to account for when you have a single property, because it's a large expense that comes at one time, and you can't blend it out over a large portfolio. So it makes a ton of sense. Did that happen to you guys early on at all, or no?
So I was doing all the work myself at first, so that probably saved us a little bit in that arena, which I don't recommend, but that's just the way it played out for me. I say I don't recommend that. Sometimes you have to do that. Like, if you're just getting going, you're probably going to have to swing the hammer a little bit, or either that, or you have to bring some value outside of just hiring consultants to do everything. You know, I don't think we got kind of lucky. We had bought that property. This is kind of a crazy story. So we bought the fourplex, lived in the basement, and then we just bought the 2 duplexes. So we were like 2.5 years into this, and an SUV crashed into the fourplex bad. I mean, it wasn't like a small accident. They said they hit him like 80 miles per hour or something. It was, we think, a suicide attempt or something. We don't know. But so fortunately, everyone in the property was okay. All the 3 people in the vehicle all died. It was a big accident. It almost took the building down. Very, very stressful time. Obviously, it was like, we're still new to this, still trying to figure this out, making sure our insurance was right. You know, it took us a long time to fight with the insurance. We finally got a total loss on the building, and we're pretty handy. I mean, really, our business was half construction basically at the beginning. So we were able to fix the building they gave us a total loss, and we paid the mortgage off with the total loss check. So the total loss covered the more, and we had like a little bit left after that, even because the insurance policy was for higher than the mortgage, right? So we used that money to fix it, took out some credit card debt, took some money from some friends, and fixed it, and then went back to the bank and refinanced it. So at that point, we had almost a new building though. So it worked out. At the end of the day, as very stressful time. Keep in mind, we lived in it too, so we lived with the friends through the whole experience also. So, but at the end of the day, it kind of taught me what the refinance was all about, because I had paid off the mortgage with the proceeds, and when I went back to refinance the property that we had bought for $225,000, they valuated it at $575. So it was like 2 years later. Now, we did a complete renovation on it after the accident, right? But then, you know, you can imagine being whatever I was at that point, 23 years old, and seeing the money come in from the refinance. It was like $350,000 or something, just deposited in my account. Now I had to pay people back, and I had to pay some credit card debt off, and I had some things. But even after all that was done, we had quite a bit of cash left, and that was, one of the many things that kind of pushed us into, going and chasing some multifamily projects and stuff. And so anyway, that's, all that being said, we did have a big expense at the beginning, but that expense was covered by the insurance, so it wasn't a huge deal.
Yeah, no, I think that's probably at the time, you probably didn't realize it, but looking back, probably one of the best things that could have happened, because you went through an experience. Yeah. Probably one of the worst types of things that can happen to a property. Yeah. And you realize that for the most part, it's, fairly manageable as long as you have your insurance in place. Do what you're supposed to do.
Yeah. And we actually had a triplex burnout last year, and it was not stressful at all, because I knew I'd already gone through the steps previous into the deal, and it's really not a huge deal. The only thing I would say on the insurance stuff is you got to hammer the insurance company. The first offer they made me on the total loss, which was the total loss one was $225. The first offer they made me was $70,000, and we got them all the way to the $225. So you have to just hammer. If you want to hire one of those insurance public adjusters, do that. I think that's not a bad move. If you got a lot of drive and a lot of fighting yourself is probably a little bit better. Mm-hmm. But yeah, so when the fire one happened, we just hammered them, and we got total loss, and basically did the exact same thing. Took the total loss money, paid off the mortgage on it, fixed the property up, went back and refinanced it, and smaller deal, but similar numbers and percentages. Which crushed it at the end of the day.
Is there any reason, and maybe it's the mortgage itself, you don't just fix the property up and then refi out the current mortgage for a new one?
Yeah. Okay. Yeah, that's important. So if it was a commercial loan, you probably could do that. But with the residential loans, the insurance check is made out to myself, you and the insurance company are both endorsers on the check. And you and the mortgage company are both endorsers on the check. The mortgage company holds the money. So then they want to give you like draws as you complete the process. Mm-hmm. And at the end of the day, they want to see you spend all that money. And they're going to be concerned if you haven't spent all that money, because that's their asset, right? And the insurance company said it's going to take, $200,000 or whatever to fix the property. So if you don't spend all that $200,000, the mortgage company is going to be scratching their head like, hey, did you guys actually fix the asset up? Because that's my collateral to my loan. Not to mention they got to do like inspection requests. It just complicates the situation. If you were super strapped for cash, you might have to do it that way. Mm-hmm. In our scenario, we had enough liquidity where I felt like we could manage kind of figuring out how to make it work. It's just less. I'm like anti-paperwork, anti-red tape. So for us, it was like, if we can just pay it off and be done with it and have that out of the equation, then we can, I think, run a little faster. And at the end of the day, real estate's kind of a speed game to a certain degree, especially when you're talking about rehabs.
No, I hear you.
Yeah, it's the same thing on the commercial loans. They typically have a threshold though. So like the fire we just had, two-party checked us and CBRE. I got it, signed it, sent it to the bank. They hold it, but that's because it was over the $25,000 threshold. So it's the same thing in that world. That's where a public adjuster can, you could fight the battle yourself, but most people just don't have it in them to push through, and they just give in. That's where public adjusters become extremely valuable, because they get paid based on how much they get. So they want to get you as much as they possibly can, and then they're going to get a delta. So, no, it's a good point. And you're right. It's a speed game. And if you want to battle it yourself, if you got a good guy working for you, they also have good relationships. It's a small world. Right. So like we had a major loss on a hurricane, and our public adjuster was extremely familiar with a lot of the people that were putting in the bids and everything. So that relationship alone was, so helpful to us in the long run. So I think you bring up a good point where, who you surround yourself with is going to help get this through. And you're right, cutting through the red tape and all that stuff, it's a pain in the ass. So, the quicker you can get something done like that, the better the better everything goes. Because you're right, there is a speed element to this, whether you're rehabbing, fixing, flipping, whatever you're doing, the faster you do it, the faster you can get income generated, the better you should do overall. So I think that's important to know.
Yeah. When we're on the subject of insurance, I got another good insurance story that we just happened this year. We bought this storage, and this is a great lessons learned. I didn't even know this was possible. So we bought this storage facility. We're under contract on it. we have a roofer come out and do an inspection. It was a recommendation because it's a metal roof, so we didn't have a storage roofer. So if someone else gave us a recommendation to this roofer, he comes out, looks at the property, says there's been hail damage, and I think it was recent in this other storm. And keep in mind, we're still in a contract at this point. And he had this idea. He was also a public adjuster, so he said, "Listen, forget my roofing quote. Let's go after a claim on this against the seller's insurance." And we're going to get the seller who was just kind of mom and pop show to sign over the proceeds of the insurance claim to us. And it felt like a long shot to me. It was kind of a Hail Mary, but it was a big number. We were chasing a $500,000 roof claim for a metal roof that was mostly cosmetic damage. So we don't even got to spend a lot of this. Some of it we had to spend, but not all of it. So
how much was the property?
Claim. The property was only 1.4 million.
Okay.
So the 500 was our entire down payment. We had some CapEx in the loan and stuff. So the loan was 1.4. So our down payment was, long story short, it was our entire down payment. We ended up being less than the 500. But so long story short, he was able to actually post closing. So we closed on the property. We've kind of forgotten about it at this point, but he's still kind of working in, touch base with it every 2 weeks or whatever. He finally got the seller's insurance to settle at the check to us was $325, I think.
Wow.
So, and that was after our entire down payment basically. And this gets got even more tricky, but the check's made out to the seller and the public adjuster and the mortgage company, the old mortgage company. So then we end up with the check, and we're like, okay, how do you deposit a check that's made out to all these other people? So fortunately we had a relationship with the bank, so that was easy to get the endorsement from. Obviously the public adjuster got the endorsement, but then you got to go to the seller who he knew what we were doing, but he had no idea the claim was going to be for 300 or 400. It was like whatever, 375, I think. And so he's like, got to endorse this check over to us. And we're thinking he's going to take off to Mexico or something with this check. He's got all the other ones are already endorsed. All he had to do is sign and deposit it. Fortunately, he didn't do that. He endorsed it and signed it over to us, and we got a bank to deposit it. So that was, but that's a good lesson learned in terms of when you're inspecting a property, if there's major damage that looks like it's from hail, there might be an opportunity to claim it on the previous owner's insurance. And the bank that we were financing with, they didn't even know about that. So we didn't do it as a CapEx. So it was just free money at the end of the day. We had the money in there for the roof already with the bank loan because we didn't know if we were going to get the money. So we put the money in for the roof on the CapEx budget with the bank. Mm-hmm. So anyway, that's kind of long-winded, but it was kind of a cool experience, obviously.
No, I think that's huge because I don't think I would have thought to do that. I don't know about John, if you've ever done anything similar.
No, but we've looked at things, there's a lot of things that insurance would cover that you may not even think to put through insurance. Obviously there's little things that it's not a shop, but if there's major problems, I mean, it's a great selling tool. It's like we looked at it, after one of the hurricanes that hit Texas, after that hurricane, when we flew to,
the deals in Houston.
Yeah. When we flew to Houston, a lot of those deals were beyond mangled. And the question was, sell it at a discount. You guys keep your insurance proceeds, but sell it to us. Let's say it was $1 million insurance claim. Instead of getting $5 million, we'll sell it to us for $3 million. You keep your insurance money and we'll take the damage and we'll fix it, because it's the reverse. Instead of buying it at the premium and getting the check,
right,
the seller doesn't want the headache of anything. Let him take the money and we'll take the deal. So it's the reverse of that. But yes, it would be similar to that. It's, you look for an opportunity. If the seller's, oh my God, if I get an insurance check, I got to fix this. Well, what's the easiest way to get it to the finish line? You get the money, we get the deal, you sell it to us at whatever the cost is, and then the money goes to you. Then you don't have to worry about endorsing checks and that stuff. He'll deal with his insurance. You take the property at a discount and you fix it. So, your value add is in fixing it, but it's the same thing, just engineered backwards.
Yeah. I do have a question though. What is an adjuster, what's that structure typically look like?
10% of collections would be standard. If it's a big claim, you might be able to get 8% or 6%.
Yeah, you could beat them down. I think on ours it was at 6, but it was $1 million change.
Right. Yeah.
Over.
Yeah. So big claim.
Yeah, they're typically in the 10% range, and I mean their job is, this doesn't cost $50, it costs $250, because they just want to keep, they'll keep pushing it up, and as an owner, go to work, brother. Like, do what you got to do. I don't care. Get me as much as possible because, if you get 800 and they could have got you $1 million, even at 10%, you got an extra 100. So it's a win-win. It's really more or less a win-win when, as long as they don't not get you anything, then you lose. But that's a gamble you take, and that's typically not the way it goes.
Yeah. Yeah, I mean, my experiences with small shop real estate, when you're talking about under $2 million assets, insurance claims typically is a winner for the owner. The owner is going to typically win on an insurance claim. I think that becomes less and less true when you start dealing with a $20 million asset or a $25 million asset.
Yeah, we had two really good ones. I mean, at Woodley Oaks deal we sold, we had hail damage. The adjuster came out and complete loss. So we got brand new roofs for $280,000, and maybe there was $50,000 in damage, give or take. So we won there, and that was a $10 million deal. And then on the deal that the hurricane hit, but that a hurricane damage is a lot more than just you need roofs, right? You have income loss. You have a lot of components to when you lose 66 of 99 units and you got to rebuild everything. So there's a lot of moving parts. So, but I agree. I mean, it's a delicate line to balance. The other thing you got to remember is when you put in a major claim, your renewal is going to be messed up on your next year's renewal. So, the recommendation here isn't just, look, there's a little, there's a gutter hanging down. Let's go through insurance. You got to be calculated about it. If it's a major fix, that'll help you. But, even if a seller puts it in, and you get the money or whatever that looks like, what are the insurance brokers always ask us? Give me 5 years loss history, because they want to underwrite the deal to see what their loss potential is. So there's a risk that comes with it, but it's calculated. Like you said, you get free money that you can use as a down payment. I mean, it's a win, right? Your insurance, even if your insurance goes up 20%, you still got your down payments way more than your cash on cash is going to be fine. So you gotta be delicate in it when you do it, but I mean, it could be extremely profitable for all parties involved, as long as it makes sense.
Right. Yeah.
I think that's important, because I was going to ask, is there any reason not to take a claim or max proceeds? So I'm glad you said that. I do want to circle back a little bit to kind of your journey. When did you guys start scaling into, multifamily, and then also into the other commercial stuff like the storage and the office space?
Yeah, so we bought the first multifamily in 2016, I think, 2017. It's a 63-unit affordable housing project. It's got a HAP contract on there for people familiar with that, and it's a HUD payment system process they use. This one is designed for the very, very, very low income, so people that are making essentially no money. A lot of people that have mental illness or some kind of depression or something, they may have been living with their parents then pass away, so they kind of can't take care of themselves, but they kind of can. They're a little bit independent. So it's kind of a different property. It's almost a business and a real estate. And we have a nonprofit that's on site that helps us with like case management and that kind of stuff. But anyway, it was kind of we bought it because we really like the property. We like the future value of the property. It's right in the middle of Old East Dallas, which is a really desirable neighborhood. The price point was unbelievable. It has a land use restriction agreement on it that ends in 2029. So there's probably a massive value increase when that comes off of it. For those who don't know what that is, a land use restriction agreement, or a LORA, is basically something that's put on the property to keep it affordable for a certain period of time by the government, typically in a trade-off for getting a bunch of free money from the government to fix the property up. So anyway, but we ended up liking that product, actually, that kind of system a lot. And we kind of did a lot of the learning curve, did a lot of the brain damage on understanding how those properties work. So after we did that one, we actually went and bought two more that are two of our other multifamilies are similar. The setup's a little different on them, but similar product. So we have basically that side, which is all affordable housing, and then we have another side, which is all market rate.
Gotcha.
And the affordable housing is a ton of work. All the stuff they say about affordable housing, in my opinion, is true. Like it's way more work. There's a ton of you got random maintenance stuff. You have people tearing up units. We have evictions every month. It's all those things. But also the cash flow is not touchable with the market rate deal. I mean, it's so much better from a return standpoint. So as long as you're willing to deal with those headaches, then I think affordable housing is great.
I think that's huge what you just touched on, that we've talked about before here and there. And it's the whole risk reward thing. And, what are you willing to take on and what are you willing to make? The easier something is, the easier you have access to it, the easier it is to manage it, the better quality tenants you have. It's just the less you're going to make. So if you're willing to take on problems, you're willing to take on risk, you're willing to take on, different geographies that people don't want, you're going to get more return for it, but you have more risk associated with that. And I think your mindset is great, is because so many people you talk to are just like, oh, I want an 8 cap, I want a 10 cap, I want a 7 cap. And they don't understand what goes into it, that you're allowed to get it. There's a reason stuff in Miami, New York, Charlotte, DFW, that's market rate, 2015, 2020 built, doesn't sell for even 6 caps anymore. It still sells for 4 and 5 caps.
Yeah.
Because it's because they're fairly easy to manage for the most part compared to other things. It's much more difficult to buy something that is 1970s built in a C-class area. It's much harder to buy something that is 50% occupied. It's much harder to buy something that has, all bunch of government contracts and agreements on it. So I think you touched on a huge point where, yes, those deals can make you way more money as long as you're going into it eyes wide open and you have certain expectations. If you think you're just going to come in and make double-digit cash flow and sitting back and it's going to be truly passive, you're going to have a very bad time.
Yeah. And I think when you get to like bigger properties, you might be able to hire a property manager that knows how to navigate some of that stuff. But if you're going to go buy a 16 unit or a 20 unit and that has a bunch of government contracts on it, there's no management company, at least that I found in Dallas, that wants to deal with that kind of stuff, that knows how to deal with that kind of stuff. So you might be able to find a management company that'll kind of manage the maintenance and the leasing a little bit, but no, they're not meeting with HUD. They're not meeting with the DHA or the housing authority. They're not meeting with the city. They're not. So
there's not enough money for them.
Yeah. And they don't know how to do that. And it's frankly pretty freaking complicated. So fortunately my wife likes like kind of the brain damage work. So she'll go in there and like read about all this stuff forever. I'm like, it bores me to tears, but she's done a good job of kind of wrapping her brain around that. And we got an employee that also has done really well at kind of learning about that and taking ownership of that. So.
No, that's good. I do have a question, because it's something we've spoken about and we've gone the opposite direction of not going into other stuff where it's storage, office, retail. We're just like, we don't know it. How are we going to be able to do better than someone that does know it? What was it that led you into going into other avenues? How did you overcome them? How did you get comfortable with the process? Or you just said, fuck it, we're going to take a chance and see if it works?
Yeah. So that's a great question. In general, I think I would advise people not to do what we've done. We're very focused on cash flow and return. And one of my business partners, we didn't have business partners for a long time. Then when we bought the 63 unit deal, we had a guy come in with us at 30% of that deal. And it was because he had found the deal. He found the deal and brought it to me and said, we need to get this. Well, he found the storage deal also. He's really got a huge network. He's a broker. He's actually a hotel broker by trade, but he's just very involved. A young single guy who just out there knows hundreds and hundreds of people, right? So someone called him about this storage deal and wanted to sell it as land for a hotel development. So he started looking at it and he's like, okay, the guy wants to sell at land price. So it's got an asset on it. Let's see. The asset's being completely run in the ground, 40% occupied, because the guy thinks it has no value. But we got looking at it a little bit and called some storage brokers, and it was like, damn, dude, if we can get this thing running, it can be worth $2.8 million, $3 million. And we're going to buy it at 1.4, put maybe 4 into it. I mean, it seems like a really good play.
Yeah.
High teens cash flow once it's stabilized. And so we just jumped on it because we knew it wasn't about, we just knew that we had a really good deal on our hands. So it's like, okay, we got a great deal on our hands. Like, let's figure out how to wrap our thing. Yeah. Yeah. It was like, we can mess up here and still make money, basically. It was going to be pretty hard to screw it up, I think. So
I'll continue.
Yeah. So, I mean, that was the key, I think, there is it's like, if you're going to go learn something new, it better be a smoking good deal when you get into it.
That's exactly, and not to cut you off, but that's every time like my partner brings it up or we talk about it, I say, we don't know anything. So you can't just go buy a marketed deal in that space. But if it comes through a channel where it's being looked at incorrectly, or there's just, you can make mistakes and learn. That's how I tell people, or how I would look at a deal. If a deal came in a product class I didn't know, well, what is this being marketed as? Is there an opportunity here that people may or may not see? Not only the owner, but maybe the broker's looking at it wrong, or maybe it's a hotel broker selling a piece of land, or maybe it's a land broker selling an office building, whatever it is. But that's an easy way to pivot where, like you said, you can mess it up and fuck it up. And, worst case scenario, you break even or you make a couple dollars, and it's a learning experience. And that's how I would recommend going into that stuff. Because we talk about it all the time. And a lot of the times my partner will say, well, why don't we look at this? And I'm like, what do you know about that? Right? You can't, you gotta look at it through an alternative set of lenses. You can't go after that deal and try and compete with the people in that class. You're never going to win.
Right. Yeah. Yeah, and then the office deal was a similar situation where the person was selling it as land value, and we had this concept, which I think is maybe still a good concept, but COVID kind of screwed us up a little bit. We bought I'm actually here right now, but we bought an office building and we wanted to kind of make a co-working suite, separate suites for only real estate focused investors. Mm-hmm. So we did that. It's got 9 offices and then a co-working area, and we had them all pre-leased, and then COVID happened and about half the people dropped out, and we've not done a lot of marketing since then. So we'll see how it all shakes out. But the idea was to kind of have this incubator space where we could, and everyone saved money. I think everyone's been here has made money. In fact, we just had a window quote that we were at I think $105,000, and someone else was like, hey, you need to call this guy. And he's for identical windows, almost $82,000 or something. So it's like little stuff like that where you just have people at your fingertips that you might not spend the time to call someone and ask them, but since we're all here, it's really easy, and there's a kind of cool community built around that. In general, though, I don't like the office space. The other office deal we have is kind of a similar, where it's like these small suites, but they're just more like blue collar companies. They're hard to lease. There's no great market. It's not like you can just throw stuff on Zillow or throw stuff on. There's no, you can put on LoopNet or stuff, but the guy that's looking for small space is looking on LoopNet or CoStar. So it's kind of I'm not into it. The office space, we kind of fell into them. And we got very, very, very appealing pricing, so that's good. But in general, I don't love it. They're hard to lease, and maybe once we get them all leased up, they'll stay occupied. I think that's that kind of idea. But right now, it's not been a great experience. It's not bad. I like having an office myself, which is great. But outside that.
So
but anyway,
basically a little quasi self-serving, and one that you just felt was too good to pass up.
Yeah, exactly. Yeah.
I do like that incubator idea. I think that's interesting.
I was about to say that incubator idea is pretty cool. And even when we were looking at office space, it was let's find a small building where we can take an office, and if you rent out the other side or the other piece or the other units, it's extra money, but you're going to pay money for rent anyway if you want an office space. So when we were looking at stuff, it was okay. Can we find something where we could pay money that we would normally pay for office, but maybe there's a potential to lease out some space to save some money, or that incubator idea is really good if you can get the right people in there. I mean, that's just a think tank for just pretty cool things. Like you said, saving money on windows is just one example, but you never know where like minds are going to come together. So I think it's a pretty cool space. I think obviously Corona and COVID messed all that shit up. But
messed the timing up on it.
I think it'll come back. Those people still want. Listen, nobody who wants to work by themselves in an office with nobody, right? It's not. Right. Some people can do it, but there's a level of even myself. I love working at home. I mean, it's been phenomenal because I have a 16-month-old daughter, so I get to spend a ton of time with her. Yeah. But there is something about sitting in an office and collaborating, and something comes up, and not having to jump on a Zoom call or a phone call. There is something about that. I don't think will ever go away, but I think it's just the right group of people you want to concentrate on.
Right. Yeah. One of our ideas, originally we had a title company that was committed to it, and that was going to be cool because we could do our closings just at our office or whatever. And there were some things that, hopefully some of that stuff comes back around. We had a wholesaler that was going to be here, a single family wholesaler. So it was okay, they can just be right. If they find deals, they can just call us first, right? So I think there is a lot of potential. At the end of the day, this is the interesting thing. Real estate people don't like to lease. They want to own stuff, right? Yeah. So we had a lot of trouble with the investors, they wanted to buy part of it. And we talked about that, just basically sell off 20% to you know, 5 different people or whatever. But the real estate people, they like to own stuff. They don't like to rent. That's their, you know, that their business is renting stuff, not renting from people. So anyway, I do think it's a good idea, and I'm hopeful that long term it turns into something really cool. It's cool already, but I think it has the potential to be something very cool.
Yeah, I like that. So I do want to touch quickly on you know, everything with COVID. How have you guys been managing the process? Have you guys been hit a lot? You know, did you guys change anything? Are you changing anything going forward?
Yeah.
How's that been?
So I think that the long story short, which I think is a similar story to almost everyone I've heard, is rent collections have been pretty good. Like I haven't talked to anyone that's been like, I got hammered, man. We only collected 70% of rent or whatever. You see these national statistics, and it's almost hard to believe them sometimes based on the people I'm talking to. But we probably end up with like 98% of what we normally would end up with or something. You know, we have the affordable housing, you have collection issues already. So this did not help that. And we definitely had a couple people in the affordable housing that were like, I don't have to pay rent. You know, but those people we got judgments against, and they'll have to figure out what they want to do with that. They probably won't pay them, but they'll have to deal with that at some point. So anyway, so in general, I would say the collection side has not been horrible. I do think the small time landlords kind of win in that scenario, because it's easier to not tell your property manager, I'm not going to pay. But if you're telling like the owner of the property who like you kind of know, I'm not going to pay, I think there's some sense that it's been easier for the small time landlord. It's harder to tell the owner you're not going to pay than it is to tell some random management person. So and outside of that, I mean, the banks have changed. The small banks that we work with have changed, and they're going to be more strict. It's going to be harder to get debt for the time being. I think that could be short-lived, but for now it is. So we're trying to have more liquidity, put more work into our, if we're chasing stuff. When we've chased stuff since COVID, we're putting more work into the pro forma, more work into the presentation, bringing photos, bringing bids. Where, I mean, some of these small banks pre-COVID, I mean, I could just basically send them a sketch out on a napkin and say, hey, this is what the deal's going to cash flow. Give me a loan. Boom. And they give you a loan. Now it's, you know, we're having to do a little more work. That being said, I still don't think it's going to be that complicated to get debt. The only thing, I think the LTV for me, we used to get 80% LTV. I think it's probably going to be 75% LTV. The rates didn't come down like I thought they would. The rates have only come down to 4.75 with our local banks. I've called like probably 20 banks. No one's lower than 4.75 in Dallas. So I don't know why that is, because typically they're a point or, you know, half a point over prime or whatever. So I thought they would have come down more. And then they want to see more liquidity in the bank. They want to see money left in the bank after you close on a deal. So a lot of money left in the bank. I think they told me they'd like to see 20% of our net worth in liquid. So if you're a dude like us who's only ever bought real estate for investments, we don't have stocks, we don't have anything. I mean, we have nothing. So there is no liquidity outside it. So everything's in real estate. So we kind of look at it saying, okay, well now let's figure out how to get in the stock market. Actually worked out, obviously, because when they first started telling us the market was tanked, so I took like $100,000 and put it in the market. And
look at you.
It worked out pretty good. I looked like a genius there for a second. It was like total luck, but it was worked out good. So
time the real estate market right in 2012, time the crash right in 2020. What should we be doing next? Tell us. Come on. Where are you going next? I'm following you.
There's obviously work is involved in real estate. No one's going to say it's not about hard work, but there also is a bunch of luck. And anyone that, you know, there's all these young people out there now that have made a bunch of money in real estate, including myself. But all of us have the same advantage, which was we got in the market and then the crap went way up in value. And yeah, they made much money. And some people made a lot more than we did because they, you know, leveraged out harder and whatever. But, you know, you couldn't screw it up. You almost could not screw it up when you were buying stuff in 2012, 2013. 14.
But the you know, what do they say? Rather be lucky than smart any day of the week. But at the same time, you know, as lucky as you were, or maybe you weren't, you took the action to get yourself lucky. You know, I joke around with people. I joke around and I say, listen, take $50,000, buy something. If you fuck it up, you lose $50,000. Know that going into it, but the experience you're going to get from learning that is going to be, you know, it's going to be second to none. So yes, you know, I did the same thing. I'm a former financial advisor. I hated that job with a passion for 3+ years, 3.5 years. But when GE is at a 30-year low, it's like, all right, let's go buy some, right? And yes, I bought some shit this year when the market was plummeting because it's like, all right, well, it ain't, what's it going to go down to? It's not going to go to zero. It's eventually what goes down must go up. So, or what goes up must go down. So it's down. It's going to go the other way at some point. So yeah, I luckily did the same thing. But at the same time, you at least had the, I'll say this, you had the balls to do it, right? You took $100 grand, you bought some shit. and people don't realize that, yes, it may have been luck. Yeah, it may have been, you timed it right. But at the same time, you still have to do it. So you could talk about it all day, but if you don't make the investment and do it and buy something, then you're sitting back in 2020. Now you're looking back and saying, shit, we should have bought that fourplex. We should have bought that duplex. And now look at it. Yes, maybe collections aren't as good as you want, and the office building's not going 100% according to plan, but you're still living, breathing, and you're young, and you're going getting after it. So I think that's the most important thing that anyone can take from anything is you got to be in it to win it. So whether it's lucky or hard work, or the smartest or the sharpest tool in the shed, you got to be in it to win it. So you got to take some risks.
Yeah, completely agree. That's it. I mean, you have to like risk to a certain degree almost to be in the real estate game, because there is a bunch of I say that it feels like it's very risky sometimes. I don't know that it's some of the stuff's actually that risky that we do, but when you buy something and you put a lot of money into it, it feels scary. Even if you've done all the numbers 3 times and it's not actually that risky, it still feels like, man, I just put a bunch of chips on the table. I hope this works.
100%.
I mean, it's definitely risky. You look at the hotel and retail industry and they just got smoked basically. Was retail on the decline? Sure. But I don't think anybody in the hotel industry thought they were going to go to 0% occupancy overnight. There's massive companies worth billions of dollars with hotel conglomeracies. So yeah, when you own stuff, if something changes on a dime or starts to shift, there's risk associated with that. So this time around, the residential multifamily space didn't get affected. 2008, it got smoked. A lot of things got smoked, but so yes, there's definitely risk involved, and you have to be willing to lose it all and go back and gain it again. So, I definitely agree. But I think that's an awesome place to wrap up. I thought this was an awesome episode. I can't thank you enough for coming on, sharing your story, sharing your insight and stuff like that. If people want to follow you, get in touch with you, learn more about you, where can they do all that?
Yeah, I'm only on Instagram. So if you look me up on Instagram, it's AJ Rambler. I'm on there. And I think my email and phone number on there too. So all my contact information's right there. I try and post videos about real estate. I only get around to doing them like once every other week or so, but I'm trying to be more consistent about it. We'll see if I can get better at it.
Awesome. Love it, guys. Definitely go follow him. And thank you so much for listening to this episode of the podcast.
Hey, I appreciate it.
Yeah. If you guys listening are not subscribed, I would love it if you guys would go and subscribe to the episode. And if you already are, please send it to somebody that you think would get a tremendous amount of value out of this episode. AJ, once again, thanks for coming on, bud.